$100 oil warning. Is the Strait of Hormuz about to trigger the next global shock? There is a number that matters more than anything else right now. 20 million? That is how many barrels of oil pass through the Strait of Hormuz every single day. 20 million barrels. Every single day. Through a waterway just 21 miles wide at its narrowest point. And the entire global economy has built itself on the assumption that those 20 million barrels will always flow. But what happens when that assumption is shaken? Over the past several days, tensions across the Gulf region have escalated sharply. Military assets repositioned, rhetoric intensified. Regional actors signaling deterrence. Oil traders watching tanker traffic minute by minute. Markets are not reacting to what has happened, they are reacting to what might happen next. Because oil markets move on probability, not confirmation. And history shows us exactly how this pattern unfolds. There are 4 stages to every energy shock. Stage 1 is dependency. The world becomes comfortable with stable energy prices. Stage 2 is concentration. A large percentage of supply flows through a single vulnerable region. Stage 3 is escalation. Political or military events raise the risk of disruption. Stage 4 is the cascade. Oil spikes. Inflation follows. Markets strain. We have seen this movie before. In 1973, a roughly 9% supply reduction triggered a quadrupling of oil prices and a severe global recession. In 1979, disruption tied to Iran removed a few million barrels per day from global supply. Oil doubled, and inflation exploded. In 1990, the Gulf War removed approximately 4 million barrels per day, and prices nearly doubled within months. Now compare those numbers. Those shocks involve 3 to 5 million barrels per day. Hormuz carries 20 million. Even a partial disruption, even 25% of Hormuz traffic would represent a supply risk larger than any of those previous crises. Now let's talk about the market structure today. Brent crude closed recently in the low $70s. Major banks are already modeling $90, $110 oil under a prolonged instability scenario. But oil doesn't need to hit $120 to cause damage. At $90, $100 oil, gasoline rises sharply, diesel surges, freight costs increase, airlines hedge aggressively, food prices climb. Every $10 increase in crude typically adds around 25 cents per gallon at the pump in the United States. A $30 increase. That's roughly 75 cents more per gallon. For households already dealing with elevated housing costs and tighter credit conditions, that matters. But energy doesn't just hit consumers. It hits corporate margins. Transportation companies see costs spike. Retailers face higher logistics expenses. Manufacturers pay more for input materials. Chemical producers absorb higher feedstock prices, and here's where it becomes dangerous. Central banks are already balancing fragile inflation targets. If energy drives CPI higher again, policymakers face an impossible choice: raise rates and risk recession, or hold rates and let inflation reaccelerate. Neither outcome is clean. Now consider Asia. China, Japan, South Korea, and India rely heavily on oil flowing through Hormuz. China alone sources a significant portion of its crude imports through that corridor. An extended disruption doesn't just hit Western consumers. It hits global manufacturing. It hits supply chains. It hits export-driven economies. The ripple effects spread faster than physical supply constraints. Insurance premiums rise. Shipping contracts adjust. Futures curves steepen, even before a single barrel disappears. This is how Stage 3 becomes Stage 4. Not through dramatic explosions, but through pricing shifts. Oil markets are forward-looking. They price fear instantly. And right now, the fear premium is still relatively small, which raises the real question: are markets underestimating the structural risk? Because if escalation continues, if shipping hesitates, if insurance costs spike, if regional actors posture further, then $100 oil stops being a prediction and becomes a base scenario. And when oil sustains above $95 for more than 30 days, historical data shows recession probabilities increase sharply. Not guaranteed, but materially elevated. Now, what should you actually watch this week? First, tanker tracking data. If volumes through Hormuz decline meaningfully, the risk premium embeds. Second, Saudi and UAE export signals. If alternative pipelines ramp up, markets stabilize. If they don't, volatility increases. Third, the Brent futures curve. Backwardation widening indicates tightening supply expectations. Fourth, the US dollar and gold. In past energy shocks, gold often rises as uncertainty increases. This is not about panic. This is not about panic. This is about understanding leverage. The global economy runs on oil. Oil flows through choke points. Choke points amplify risk. And when leverage meets uncertainty, markets move fast. We are not in Stage 4 yet, but we may be standing at the edge of Stage 3. And history shows that once Stage 3 locks in, Stage 4 doesn't wait for permission. The next few trading sessions will tell us whether this is a brief spike or the beginning of a repricing cycle. Watch carefully, because energy shocks don't announce themselves with certainty. They begin with doubt. And doubt is already rising.